Welcome back to AI Research. Today we are diving deep into one of the most important charts in global finance, the Federal Reserve's total assets. Often referred to as the Fed's balance sheet, this line represents the sheer volume of money and support the central bank is pumping into or pulling out of the financial system. By understanding these ups and downs, you can unlock the secret to how markets move. Part 1. Analyzing the ups and downs, 2003 to 2025. The chart shows four distinct eras of modern monetary policy, 2008 to 2014, the birth of QE, the first big leap. Before the 2008 crisis, the balance sheet was under $1 trillion. To prevent a total collapse during the Great Recession, the Fed began quantitative easing, QE, buying treasury bonds to lower interest rates. You can see the steps representing QE1, QE2, and QE3 as they kept the recovery alive. 2018-2019, the first attempt at normalization, the dip. The Fed tried to shrink its footprint through quantitative tightening, QT. However, notice the tiny spike in late 2019. That was an emergency intervention in the repo market when banks suddenly ran out of cash. 2020, the COVID-19 response, the vertical spike. This is the most dramatic move on the chart. Assets shot from $4 trillion to nearly $9 trillion almost overnight. The Fed launched an unprecedented rescue mission to prevent a depression and fund global stimulus. 2022 to 2025, the war on inflation, the steady decline. Following the peak, the line begins a consistent downward slope. High inflation forced the Fed to reverse course, removing liquidity to cool off the economy. Even the 2023 blip, the regional banking crisis, was only a temporary pause in this downward trend. Part 2. Investor Insights and Strategy. This chart isn't just history, it's a map of liquidity. For an investor, liquidity is fuel for asset prices. Here are the key takeaways for your portfolio. 1. The Fed put and market tailwinds. Notice how every sharp spike in the blue line corresponds with a massive recovery in stocks. When the Fed expands its balance sheet, it devalues cash and pushes investors into riskier assets like stocks, growth equity, and crypto. When the line is moving up, buying the dip is historically a winning strategy. 2. The danger of quantitative tightening, QT. During the steady decline from 2022 to early 2026, the easy money disappeared. This leads to valuation compression, where even good companies see their stock prices struggle because money is scarcer. If the line is going down, you want to focus on high-quality companies with strong cash flow. 3. Banking fragility as a signal. The blips in 2019 and 2023 prove that the Fed will always prioritize financial stability over shrinking its balance sheet. These moments of crisis-driven liquidity injections are often the best entry points for long-term investors, as they signal that the Fed is providing a backstop. 4. 2026 Strategy. The transition. As we head into 2026, the Fed has signaled an end to the aggressive runoff, QT. We are moving from a hostile liquidity environment to a neutral or supportive phase. Institutional investors are currently looking to lock in the high yields from the past 2 years before the balance sheet potentially begins to expand again. Summary table for investors. Fed trend. Market environment. Investor action. Expansion, up, easy money, bullish. Overweight growth and risk assets. Contraction, down, tight money, volatile. Focus on quality and defensive assets. Flattening, ending QT, current phase, 2026, accumulate quality as liquidity stabilizes. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.